If you've ever thought about buying a home, there's a good chance you've experienced this. An email from a bank, a call from a loan officer, an ad showing up right after you searched for a mortgage calculator. The tone is always calm, reasonable, almost reassuring. You're pre-approved, the monthly payment is manageable. This is your opportunity to own your first home. Everything is framed as a natural step forward in life, as if buying a house is proof of stability, of maturity, of success. And most people stop thinking right there. But there is a small detail very few people pay attention to. Banks always want you to buy a house. In almost every economic cycle, at almost every income level. That alone should raise an uncomfortable question. If buying a home were always good for you, why would banks, institutions that exist to make money, be so eager for you to do it? Not because they're concerned about your financial freedom, not because they understand the pressure your life might face 10 or 20 years from now. It's because buying a home creates something banks love more than anything else. Long-term predictable debt backed by collateral and extremely hard to walk away from. Banks aren't evil. They're simply doing exactly what the system is designed for them to do. The problem is this: what's good for that system doesn't automatically align with what's good for your life. And that's what this video is about to unpack. To understand why banks behave this way, you have to be clear about one thing first. A bank is not a personal financial advisor. It's not a life planner, and it's not designed to optimize your future. A bank is a risk-managed business that sells money over time. Its job is simple: take deposits at one rate, lend them out at a higher rate, control default risk, and keep cash flows as predictable as possible. That's it. When a bank looks at you, it doesn't see your goals, your stress tolerance, or the kind of life you're trying to build. It sees a balance sheet, income, debt-to-income ratio, credit history, employment stability. From the bank's perspective, a good customer isn't someone who becomes wealthy or flexible. It's someone who makes payments on time every month for decades. And this is where mortgages become incredibly attractive. A 30-year home loan is one of the most stable products a bank can offer. The payments are fixed, the timeline is long, the borrower is emotionally invested, and the loan is backed by physical collateral. If things go wrong, the bank still has the house. That's why inside the system, mortgages aren't treated like a burden. They're treated like an asset. This doesn't make banks malicious. It makes them rational. The mistake people make is assuming that because a bank approves something or encourages it or frames it as responsible, that it must also be good for their long-term life. But the bank's definition of success and yours are not the same. The bank optimizes for repayment certainty. You should be optimizing for margin flexibility and resilience. And those two goals only overlap sometimes. When most people think about a mortgage, they focus on one number: the monthly payment. That's not the number the bank is focused on. Banks make money on mortgages in three primary ways. The first is interest over time. A 30-year loan isn't just long. It's long enough for the total interest paid to approach or even exceed the original loan amount. That's not an accident. It's the core of the product. The second is fees layered throughout the process. Origination fees, processing fees, insurance requirements, refinancing costs down the line. Each one may seem small on its own, but across millions of borrowers, they become a significant revenue stream. The third and most important is risk asymmetry. From the bank's side, mortgage risk is capped. The loan is secured. The borrower is highly motivated to keep paying. And in many cases, the risk is partially offloaded through insurance or secondary markets. From your side, the risk is open-ended. You're committing future income that hasn't been earned yet. You're locking in fixed costs that don't adjust when life changes, and you're tying your mobility, career, location, opportunity to a single asset. This is why banks don't need you to get rich. They just need you to stay employed, stay current, stay in the system. From the bank's point of view, the ideal outcome isn't that you pay the house off early, it's that you carry the loan for as long as possible with minimal disruption. So when a bank encourages you to buy a home, it's not making a statement about your readiness for adulthood or success. It's responding to a product that fits its business model perfectly, and whether that same product fits your life is a completely separate question. Once you understand how banks make money on mortgages, their behavior becomes predictable. Banks don't just want you to buy a home, they want you to buy early, and they want you to buy as much as you can qualify for. Buying early extends the timeline. A longer loan means more years of interest payments, more exposure, more total revenue. Buying a larger home increases the principal. A bigger loan doesn't just raise the monthly payment slightly, it multiplies the total interest collected over decades. That's why conversations with banks rarely center on total cost. They center on affordability. Can you handle this payment? Does this fit your monthly budget? What's the maximum you qualify for? Those questions are not designed to protect your future. They're designed to stretch your present capacity without triggering default. The monthly payment framing is especially powerful. A $350,000 loan and a $450,000 loan may only look a few $100s apart each month. That difference feels manageable, rational, even small. But over 30 years, that gap represents hundreds of thousands of dollars in additional obligation. The bank sees the long curve. Most borrowers don't. And there's another layer most people miss. When you buy early and stretch your budget, you lock yourself into a financial posture that's very hard to unwind. Your fixed costs rise before your income has stabilized. Your margin disappears just as life becomes more complex. From the bank's point of view, this is ideal. A borrower with high fixed obligations is less likely to walk away, less likely to take risks, more likely to prioritize steady payments above all else. Early buyers with tight margins don't churn, they stay. So when banks encourage you to get in as soon as you can, it's not a prediction about home prices or your future earning power. It's a reflection of how predictable long-duration debt fits perfectly into their model. One of the most dangerous moments in the home buying process doesn't involve interest rates or paperwork. It's the moment you're told you're approved. Congratulations, you qualify, this is what you can afford. Those words carry emotional weight. They sound like validation, like progress, like a green light from the system. But approval is not a judgment about what's good for your life. It's a calculation about what you can survive on paper. Banks don't approve loans based on how resilient you'll be if something goes wrong. They approve loans based on whether the math works today. Your current income, your current expenses, your current credit profile. They don't model burnout, career stagnation, health issues, or the fact that life rarely stays static for 30 years. A loan that is technically affordable can still be strategically destructive. It can eliminate margin, compress time horizons, and force defensive decisions later that look irrational in isolation, but inevitable in context. The bank's model assumes stability. Your life guarantees change. This is why so many people feel financially stuck despite doing everything right. They didn't make a reckless decision. They made a rational one based on the wrong frame. Being approved means you can make the payments. It does not mean you should. The bank is answering one question: will this loan perform? You should be asking a different one. What does this commitment take away from my future self? And that gap between approval and alignment is where most long-term financial stress begins. Let's put emotion aside for a moment and look at the math the way the system does. Imagine a mortgage with these terms: a loan of $400,000, a 30-year term, an interest rate between 6 and 7%. From the outside, it looks reasonable. The monthly payment lands somewhere around $2,400. That number is clean, predictable. It fits into a spreadsheet. That's the number the bank wants you to focus on. What's harder to see is what that payment represents over time. Over 30 years, the total amount paid can approach, and in many cases, nearly equal the original loan amount in interest alone. You don't just buy the house once, you buy it twice, but even that still isn't the full cost. What the bank doesn't model is opportunity cost. Every dollar committed to a fixed payment is a dollar that can't be redirected. It can't be invested when markets are down. It can't support a career transition. It can't absorb a medical issue, a layoff, or an unexpected change in income. Mortgage math assumes stability. Life doesn't. And then there's time. 30 years is not just a duration, it's a constraint. It shapes which risks feel possible, which opportunities feel responsible, which decisions feel reckless even when they're strategically sound. The bank sees a stream of payments. You live inside the rigidity those payments create. This is why two people with the same income can experience completely different financial lives. One has margin, the other has obligations, and this is the core insight most people miss. A mortgage doesn't just cost money, it costs time horizons, it costs optionality, it costs the ability to adapt when conditions change. The payment may be affordable. The constraint is what compounds. Now let's step away from spreadsheets and look at how this plays out in real life. Consider two families with similar incomes and similar ambitions. Family A buys as soon as they qualify. They stretch to the maximum the bank approves. The payment fits, but just barely. Their fixed costs rise immediately. Most of their income is spoken for. There's little margin left at the end of the month. Nothing goes wrong at first. They're responsible. They make every payment. But over time, the pressure shows up in subtle ways. Job changes become risky. Side projects feel irresponsible. Unexpected expenses create anxiety instead of inconvenience. They're not failing. They're constrained. Family B takes a different path. They buy smaller or rent longer. Their housing cost is well below what the bank would allow. They keep cash flow flexible. They don't feel as settled at first, but they have room to breathe. When opportunities show up, they can move. When income fluctuates, they absorb it. When markets shift, they can act instead of react. Fast forward 10 years. Both families worked hard. Both earned more than they did at the beginning. But their internal experience is very different. One feels constantly behind despite progress. The other feels calm even without perfection. This isn't about morality. It's not about discipline or intelligence. It's about structure. One family optimized for approval, the other optimized for resilience. The outcomes weren't chosen all at once. They emerged naturally from a single decision repeated every month for a decade, not through drama, but through quiet pressure or the absence of it. One of the most confusing experiences in modern personal finance looks like this. Your income goes up. You get raises. You move forward in your career. And yet financially, nothing feels easier. In some cases, it feels worse. This isn't a contradiction. It's a structural effect. As income rises, lifestyle inflation quietly follows. Not because people are reckless, but because fixed commitments expand to meet perceived capacity. A larger home doesn't just mean a higher mortgage payment, it brings higher taxes, higher insurance, higher maintenance, higher expectations. Each increase feels reasonable on its own, but together they raise your fixed cost floor. The problem isn't that expenses grow, it's that margin doesn't. When income increases but obligations rise at the same pace, pressure doesn't fall. It just changes shape. You earn more, but you still can't afford to make mistakes. A missed bonus hurts. A career pause feels dangerous. A downturn becomes personal. This is how people end up earning more money than ever while feeling more fragile than before. Not because they lack discipline, not because they made one bad decision, but because their system has no room for error. And this leads to the insight most people only learn after years of stress. You don't become financially secure by maximizing what you can afford. You become secure by maximizing how much you can absorb. It's not that you lack money, it's that you lack the ability to be wrong without collapsing. That's the difference between progress and pressure. Most people approach buying a home by asking the wrong question. How much will the bank lend me? That question is easy to answer and dangerously incomplete. A better question sounds less impressive, but it reveals far more. If my income dropped by 20%, would my life still work? Another one cuts even deeper. Does this decision increase my freedom or reduce it? Banks will never ask you those questions. They can't. Their models don't account for uncertainty, identity shifts, or changing priorities. They don't price in burnout. They don't price in opportunity. They price in repayment. So when a bank encourages you to buy a home, it's not endorsing a life strategy. It's validating a business transaction that fits their model. Whether that same transaction fits your future depends on variables the bank never measures. Time, flexibility, the ability to adapt when conditions change. Banks want you to buy a house because it's good for their system. Whether it's good for you depends on what you're trying to protect. Not your approval status, not your image, but your margin and the freedom that margin quietly creates.